But as we go, we will essentially be touching on a couple different topics today. Like always, I asked some specific topics people are interested in, but I think I'm going to go a little different of a route today. And I know a lot of people have been asking the same question. People have mentioned that they had missed like the signs essentially when the market was changing over, and people are curious essentially about like how you can tell when the market is flipping back over, how you can tell if something is bullish or bearish, when you should be entering. And I think honestly one of the biggest issues that I've noticed people are having is they're not putting in like the work. They're not doing their homework. And I know sometimes when I ask you guys what questions you have or what you want to learn or whatever, that you don't necessarily know what you need to learn. The same way, like if you ask a kid that goes to school, what do they want to learn about history? They don't know what they want to learn because they haven't learned it yet. So, hopefully what we go over today will kind of pique your interest. And then you guys will have some better questions in the future or things that I can expand on. But what I want to do today is kind of take it back to the basics. I want to take a few steps back, go over some stuff that we've gone over in the past, but in more depth, kind of like a refresher course a little bit. Because I think one of the biggest issues is the more time you spend doing something, the more distracted you get with like advanced techniques, fancy indicators, like new stuff that you heard about or learned about or whatever, and sometimes you forget about the most important thing, the actual just basics of what you need to learn, what you've already learned, and how important it is. So I have on my chart today three most common indicators, most basic indicators that I use specifically to help to determine one, the overall trend, two, when the trend is starting to show like warning signs of a potential reversal or exhaustion or divergence, and then we can go from those and kind of work up to some of like the more advanced techniques. But the number one most important thing that I always tell people, if you're going to use one indicator, people say if you could pick one indicator, what would it be? And for me, it's moving averages. If you're going to just use one thing, use moving averages. So on the chart right now, what we have pulled up is essentially just moving averages. That's all this is. It's moving averages, and then it has multiple other things added into it to make it more complex. But the most important thing is moving averages. You really only need, three moving averages. You want a short-term moving average, you want like a medium-term moving average, and you want a long-term moving average. So in this case, we're looking at the red is the 8. That's our short-term moving average. We're looking at the yellow. That's a 21. That's our medium-term moving average. And we're looking at the blue, the 200. That's our long-term moving average. All three of those, the red, the yellow, and the bright blue right here, are exponential, EMAs. The difference between the exponential and the SMA, the simple moving averages, is the exponential is weighted heavily based on time. So the 200 is going to take the past 200 times whatever time frame we're on. So right now we're on the daily. So if you look at the daily blue, the daily 200, the exponential is going to take the 200 and then it's going to weight the most recent time frames heavier. So this price action up here is going to be weighted more than the price action back here. And then the same way, the simple moving average is literally just going to take the last 200 candles, so last 200 days, and it's going to weight every single day evenly. So you'll notice that they will be different, but very similar in a sense that one has that weight to it and one does not. So you can use whatever you want. In traditional markets, people tend to use simple moving averages. In crypto, because of the more volatile price movements, people tend to use the exponential moving averages. So that's the most basic explanation of it, and that's why you'll see I have two green ones, I have two blue ones, and then I have one of everything else. Because I like to see what both people are seeing. Because there's a lot of traditional people that have been doing technical analysis for a long time that have moved into crypto. So therefore they use traditional moving averages, simple moving averages. And then there's a lot of people that understand that because of the excess volatility in crypto, that it's a lot more beneficial to use exponential moving averages. But if you say that there's a 40-60 split or a 50-50 split or 75-25 split, it doesn't matter. I'd rather see both of them because then I can see what the majority of people are seeing. Because everybody that's using moving averages is using either exponential or simple. So you can use whatever you like. You can use whatever works best. But it's best, in my opinion, to use both. Now, anybody that knows I use moving averages obviously knows that the reason I use these specific moving averages is because the numbers like the 50 and the 200, those are like traditional moving averages that everyone uses. And then for my other moving averages, I use ones like the 8, the 21, the 89, the 377, the 528, 55. The reason I use those specific moving averages is they're all Fibonacci numbers. If you're not familiar, which I imagine all you guys are at this point in time, with not only Fibonacci but the Fibonacci sequence, that's a huge reason is you can switch between time frames, and the way the Fibonacci numbers work is you can look at a Fibonacci number on a shorter time frame, higher moving average, and then when you switch over to a longer time frame, shorter moving average, they will often line up perfectly or at least very close. So when you're looking at a trend and you're trying to identify the overall trend, you can look at any asset you want and you can immediately tell, is it an uptrend, is it in a downtrend, or is it in a consolidation? So very simply, we can look at Bitcoin right here and we can say, okay, at what point in time did we enter into an uptrend? So right here, once we crossed over top the 200 moving averages. So we have our blue moving averages both lined up perfectly right here. As soon as we crossed over top of them, we were confirmed in an uptrend. We were in a bullish trend, not a bull market, not a bear market, not a consolidation phase. We were in a bull trend. If price is trending on top of the moving average, the 200, that's a bull trend. If price is trending below the moving average, the 200, that's a bear trend or bear market, however you want to determine it. There's lots of different small little bits and pieces that you can use, like the term bull trend, bear trend, bull market, bear market. None of that stuff matters. None of it matters. The definition of like a bear market is like in stocks is a 20% pullback from the all-time high, and it typically lasts so long and so long. But none of that matters. Take all the complicated stuff out of it and just look at the absolute most important basic thing is, are we trending on top of the 200? Are we trending below the 200? Or are we like basically oscillating around it and the market is indecisive, which is essentially just a consolidation phase? So if you buy in after this candle right here closes on the daily, you're going to potentially take drawdown after that move up here, but you're still on top of the 200 moving average. So rather than getting focused on trading and leverage and all that stuff, today we're going to talk about, well, in this part at least, we're going to talk about the trending markets so that you don't get left behind when a trend changes. The most important thing is look at the price in relation to the 200. Don't pay attention to anything else. Okay? And then what you do after that is you look at shorter term moving averages to determine what is the price potentially going to do, or what is the price doing in the future. So if you bought in after this right here, what are you paying attention to now? Potential trend changes, because you're already in the market with at least a percentage of your account. So how are you going to determine a trend change? You're going to look at a shorter time frame, or you're going to look at a shorter time frame moving average. So if we're on the daily and you're looking at the 200, you have two options. You can switch to a shorter time frame, like the 4-hour, and then look at price action in relation to the 200. Or you can look at the same time frame, still the daily, but you can look at a shorter period moving average, like for instance, the 21, or the 8, or the 55, or whatever else you want to look at. But the idea is essentially that looking at these different moving averages on the same time frame tells you what's happening before it happens to the 200. So if we're on the daily and you want to determine, is this trend going to potentially change to the downside, you're looking for essentially the 8 to cross below the 21. You're looking for your shortest time frame moving average to go below your second shortest time frame moving average to signify that we're potentially going to be changing the trend. So in order for that to ever happen, the price has to be below the shortest time frame moving average. Otherwise, you'll be just trending to the upside. So here, when we notice we get a move down below our 8 moving average for the first time after that 200 cross right here. So as soon as that crosses below the 8 moving average, we are potentially in the danger zone. That's like a yellow light on the traffic stop. You see the yellow light flip. It's not red yet. It's not green anymore. It's yellow. It's saying like, hang on, better slow down. What's going to happen next? Well, if it's a light, it's probably going to turn red based on everything. But if it turns green, you can keep going. So that's all we're looking at right now. If it starts flashing yellow right here, you start paying attention and thinking, I potentially want to get out of this trade. So what are you looking for once it closes under the 8 moving average? You're looking at the 21, because that's our next period moving average. And the reason we use these moving averages like this, think of it like stairs. You can jump up 2 stairs. You can jump down a whole flight of stairs. But typically when you go downstairs, what do? You take them one step at a time. And that's what moving averages are. So if you're below your moving averages, they're going to find support on them as you go down. And then finally you will find support indefinitely. And then you can continue moving to the upside. So here we broke down through the 21, found support on the 21 based on candle closes. And then we began moving back to the upside. We found resistance right away on the 8. We found sold back off. And then we moved above it. Found support on the 8. Moved above it. Sold back down to it. Found support. And then we continued to the upside. And then we broke down below it again, and we almost confirmed the cross right here for the first time. That was like our first serious warning sign that we might potentially be a fake out right here and moving back down to the upside. But what happened? We were able to save the trend and then continue. This is a consolidation, indecision phase. But again, we're on top of the 200 MA this whole entire time. So you never should be bearish on this asset. Long-term trending market is at that point in time bull trend. But if you're trading inside of this trend on shorter time frames with a separate account, that's completely different. But there's no reason that if you were just accumulating or you were just holding or you were essentially separating your account into multiple time frames, that once you're on top of the 200, that you should be in the market, or at least based on this trading strategy, that's what I'm doing. So when people say they missed when the trend flipped over, this is it. This is when the trend flipped over. We were below the 200 for this period right here. That's when you did not necessarily want to be in the market with your trade hold account. Here is when you did want to be back in the market. So that's your most basic, simple way to keep track of it. And that is essentially the first step in the most important thing, which I've noticed that I don't think anyone specifically has ever posted up the entire time that we have had this group. A couple people have specifically spoke to me and talked about things, but I have never seen not one person ever post up their trading plan. Never. After all the months, after all the things they've learned, after all the videos we've done, no one has ever posted their trading plan. Not for the group to look at, not for me to look at. I've talked about it with quite a few people. They've told me that they're working on their trading plan, and no one ever finishes it. No one ever posts it up. Well, the trading plan should start in steps. Just like when you write a book. What do you do when you write a book? You don't just start writing chapter 1, page 1, and start talking about whatever you're going to talk about. No, you write an outline. So that's what you should be doing. You should write an outline for your trading plan. So step 1 in the outline for your trading plan. How to determine if you're in a bear market, a bull market, consolidation period. So how do you determine that? The 200 moving average is the number one most basic way to do it. So there you have it. That's step 1 for your actual determining of the trend based on, do you want to be in this asset? Do you want to be going long in this asset? Do you want to be going short in this asset? Now inside of the move on top of the 200 moving average, you can play these moves like this, the 8 and 21 crosses. You can try to get ahead of the market if you think it's going to start going to the downside because you start getting these crosses. You can start doing whatever you want inside of it. You can get, warning signs up here that we're potentially going to top out based on the Parabolic Star and we're going to sell back off. But when we sell back off and you stay above the 200 moving averages, whichever one you're using, the exponential or the simple, you should be positioned still to the long side, to the upside. You should still be bullish on this market long term based on the 200 MA. And if you were, you might have gotten out right here when we get the cross, or we get indecision, or we flip over the Parabolic Star, but that's on a trade account. That's on a shorter time frame scalp. Okay, an actual trending move, you should have stayed bullish this entire time through this whole period. On your hold account, on your buy account, on your long account, on your hodl account, whatever you want to call it. But the actual trading inside of that is what these shorter term frame moving averages are for. But until you sell back off below the 200 moving average, you shouldn't be looking to get out of this asset on a long-term positional hold. You should be overall invested in this asset based on that. Whatever it is, Apple, Tesla, the S&P, no matter what the fundamentals are, no matter what anything else is, based on technical analysis and trending moves, as long as you're above the 200, you should be bullish on that. And that specifically tell you, if you got bullish down here at 10,000, you doubled up since then. And at some point in time, what's going to happen is we're going to finally top out this trend. And when we do, we're going to come down and test these moving averages one after another. And then finally, we're going to do something that is inevitable in every market ever to exist in a long enough time frame. You come back down and you retest the 200 moving average. And one of two things is going to happen. You're going to retest it, you're going to find support, and then you're going to continue to the upside. Or you're going to retest it, you're going to fail to find support on the 200, and you're going to continue to the downside. And that is essentially what we're looking to happen to get out of this trade on a long-term basis. Now, if you wait for that to happen, and you're in this market at current price 18,000, that means we're going to sell all the way off back down to 12,100 before you know for sure. So what do you do along the way? You take profits, of course. You're not going to just eat a $6,000 dump to the face before we find support right here, and then you decide, oh, we found support, so it's going to continue to the upside, so I don't need to make a move. That's what you use take profit levels for. That's what you use stop losses for. That's what you do to protect yourself. But if you have your crypto on a ledger, a hard wallet, in an account without a stop loss, you're not in that position. So you have to manually take profits on your positions so that if we do get a violent sell-off, you don't just eat that 50% drop to the face because you had to wait $9,000 dump right here, or $6,000 dump right here, or even a $2,000 dump right here because you were waiting for that to take place. So that's what we're using the shorter time frame moving averages for on the same time frame as, to determine, hang on, are we potentially in the danger zone? Do I need to make sure to manually take profits? If you're using an account on an exchange somewhere and you have stop losses in place at all times, you don't need to worry about that. But most people do not just keep a stop loss in place on a trending position. You keep a stop loss in place on a swing position, on a scalp position, on a leverage position that you're expecting to hold for a short period of time. You don't just go into like your 401k, a long-term investment and have a stop loss in place at all times. That doesn't make sense. You should be overall determining one way or the other like a light switch. It's either on, which means you're bullish, which means you're in a bull market, which means you're, in this case, above the 200 moving average, or you're not bullish, you're bearish. In that case, you would be below the 200 moving average, and you have your light switch turned off. You're risk off in that asset. So that is the most basic, most important thing that anyone can understand or learn about these markets. If you're not profitable in assets, that's where you should be starting at. That is the basis foundation for everything is. You should be able to look at any chart at any time on any time frame and look at it with simple indicators on and tell, is this asset bullish? Is this asset bearish? Are we in a bull trend? Are we in a bear trend? From there, you can determine, are we in a bull market? Are we in a danger zone? Is there yellow lights flashing? Is there red lights flashing? Are we going to get continuation to the upside? But that's where everyone should be starting at. That's the first step in your trading plan should be before you start worrying about risk reward, before you start worrying about, swing trades or whatever else it is, you should be able to look at any chart on any time frame and look at it in just a moment and tell, are we in a bull or are we in a bear market? So that's step one, basically. Determining the overall trend of the market. I think people get overcomplicated, get too many fancy indicators, watch too many videos, Google too much stuff, and just lose sight of the most important thing. And that is by far the most important thing. It is by far the most commonly used thing. I mean, it's great to have stuff like RSI and stochastics and MACD and all that stuff. Those are all great indicators. They're absolutely fantastic. I mean, they're some of the most common indicators in the entire world. But before they ever had all this fancy stuff, before they had all these fancy computers and everything, if you went down to the stock exchange and you saw what people used, the most advanced traders at the time, 100 years ago, were calculating moving averages by hand and figuring out, were we above those moving averages or below them? And we've just gotten spoiled with all our computers and all our fancy colors and all this stuff in the meantime. But if you read old books from the 1900s, if you read, Charles Dow theory, if you read all this different stuff from the past, you will see that they are the most effective, most efficient ways, and that everything else is built on top of that foundation. So that's what we're going to build on top of today, is the 200 moving average. And then from there we can get more complicated. So now after you take into account that, my next favorite thing to look at is stochastics. I really like stochastics because they help you to determine inside of that trend what is happening based on momentum. So if you're above the 200 moving average, we know that we're in a bull trend, a bull market, we're moving to the upside. How do you determine if we're gaining or losing momentum? The same way that a car could be driving down the road, the engine could stall out. The car could still be going 50 miles an hour, but the engine is off. So what's going to happen? You're going to lose momentum because there's nothing propelling you forward. That's what our stochastics are for. The stochastics are telling us the momentum of the market. They're not telling us the speed. They're not telling us the velocity. They're telling us, are we gaining or losing momentum? And that will help you to determine if a trend is potentially going to top out way before selling all the way back down to the moving average is going to tell you. So right down here, we have essentially the stochastics. But what I've done is simplified them. Rather than having your two typical stochastics, a long time frame and a short time frame, whatever you're using, a 12 and 26, a 8 and 25, whatever you want to use for your stochastics, it doesn't matter. But what it's telling you is you have a shorter time frame one and a longer time frame one. And when they cross down to the downside, normally the shorter time frame one crosses below the longer time frame one. It's the same exact thing as a moving average. It's telling you that you're essentially losing momentum in that trend. In this case, it's simplified, so when they cross, you're only seeing one line ever. You're not going to see the two different time frames. When they cross down to the downside, it's going to go from that blue to that red and tell you they've crossed down to the downside now, which means we are losing momentum. We are now gaining momentum to the downside. So once we've lost momentum is when you see the peak right here, and that's saying now the shorter time frame and the longer time frame are crossing in the same way that the moving averages are crossing. And that's exactly what happens when it flips over blue right here. It's saying now there's been enough of a change that the shorter time frame one is above the longer time frame run, and now we're flipping back over and the trend is gaining momentum to the upside. So you can have times like this where you're at the top of a range, losing momentum, but still in an uptrend. Gaining momentum, but at the top of the range, so you're in danger zone. Losing momentum, gaining momentum, losing momentum, gaining momentum. And then we're gaining momentum to the downside now, violently, based on that move that's taking place on the daily. So what's happening right now? One of two things is going to potentially happen. You want to essentially use these indicators oscillators to predict the market and what's going to happen in the future. So what's going to happen? We're either going to lose momentum to the downside, this is going to round back out, and then we're going to potentially move back to the upside, and this would flip back over blue, or we're going to continue losing momentum to the downside, either more violently, which is pretty much impossible because we're going almost straight down right now, or we can still be moving to the downside, but at less violent of a move, and this would start to like round out a little bit. We could then have another dump. We could then pull to the upside. Anything could happen, but essentially one of those two things is going to take place. So now what's happening in the background right here is we're using this area above the 80 or this area down here below the 20 to determine, are the bulls in clear control, which is what this red means right here, or are the bears in clear control, which is what this green means right here. So just looking at this, if you didn't see price action whatsoever, you can tell by the amount of red on the screen that the bulls are in control, violently in control, because there's a ton of red and only a tiny bit of blue, green. So it's very clear what's going on right now. You don't need much information to tell that. You don't need to even see price action. So we know that we are trending to the upside based on this right here, and we know that the bulls are in the control zone right here. So you're going to see these hard sell signals start building at the top right there. You can take those as however you want. You can take them as a shorter time frame scalp trade that you're going to move inside of the daily, or you can look at the specific signature that I like to look for, which is a hard sell across to the downside and an exit of the bullish control zone. It means the bulls were in control like this. The bulls are in control this whole entire time. No matter what happened inside this little micro moves, the blue and the red switching, the bulls are in control this whole entire time. The bulls lost control right here when we sold out of that area. Otherwise, if the bulls could have, they would have saved price action like this and kept moving it around inside here, and price would keep floating up. So that's where we start to look for divergences and things like that. We start looking for hard sells. We start looking for important things like crosses between the RSI or the EMA of the RSI. But more importantly than anything, we are just looking to see who's in control. The bears were in control back here. The bulls are in control this whole entire time. So the bulls have been in control in this market since 11,285. So you should be bullish in the market if the bulls are in control. It's like in a game, sports game, if one team has possession of the ball for, 75%, or in this case, let's say 50%, and then it's neutral through this area for the other 40%, and then 10% of the time, the bears have control of the ball. What's going on here? We're clearly in a bull market. We're clearly in a bull trend based on just the stochastics. And then all the stuff that's happening inside of here, all these red and blue and everything, is just helping to tell you, are we gaining momentum or are we losing momentum? But it's very clear the bulls have the ball. We're in the bulls court right here. And it's the same way when you look at something like the MACD. You can look at the regular MACD if you want, or you can look at my version of the MACD. Either one is perfectly fine. There's nothing wrong with using whatever you like better. But in this case, it's the same thing again. It's just simplified to make everything easy. So if the histogram is below the slope line right here, that's just the moving average of the MACD. If the histogram is above the moving average, it's bullish. If the histogram is below the moving average, it's bearish. And then if it stays above it long enough, it's going to flip it over a blue, and it tells you we're in a strong trending trade, trending market to the upside. If the histogram moves below it for long enough, it's going to flip it back over red. And what's that tell you? We're in a strong trending move to the downside. But essentially it's telling you the same thing. It's the moving average convergence, divergence. It's telling you the same thing that these moving averages are telling you right here, but it's telling you, are they converging, moving closer to each other, as in losing momentum in that direction? Or are they diverging, as in moving away from each other, as in the gap is getting bigger between the 2 period moving averages? So in this case, once the gap gets big enough and you're moving in a trend long enough to the upside, this will flip over blue. And then the histogram will stay above that. And as long as the histogram stays above it, we're trending to the upside and we're in an upward trend. Right here, what's happening right now? We have now sold down and the histogram is touching the moving average. So one of two things is going to happen right now. Okay, the market is going to find support right here and then move back to the upside, and this will stay blue. Or the market is going to move down here. The histogram is going to go below the moving average on the MACD, and eventually, if it stays below it long enough, it will flip it over red, and then we will be in a long trending trade or trending move to the downside. That's the absolute most basic, simple way to look at these things. All this green, all this red, the slope line on the histogram, none of that matters. The only thing that matters is the histogram above the moving average, or is the histogram below the moving average? The color of the actual moving average doesn't matter either. It's only if price action is above it or below it. In the same way that you're looking at the 200 moving average on price action, are we above it or below it? when you take these three things and put them together, they are extremely powerful. Because if you look back here, this will tell you on the daily time frame, once we moved above the 200 moving average, we were in a bull trend. We have never fallen back below that 200 yet. So if you just bought right here, once we went above it, 8,000, you would still be in the market right here. But again, the problem is you would have to go down to 12,000, fail to find support right here before you would get out of the market. So for me, this is entry point number 1 for my trading plan. Moving average cross. Once we enter over, once we cross over, once we're on top of the 200 EMA or SMA or whatever you want to use, we're in a bull trend. So I enter the market with 25% of my position. I enter into a long position and I start to look for other places, other important areas to add additional capital based on the trend. Because what I don't want to happen is I don't want to buy in on this candle right here because now we're on top of it and then it sells back off and then we go straight back below it and then we trend back to the downside. The reason I don't want to do that is I don't want to give up this portion of my account right here. So that's why I don't just go all in as soon as we cross above it or all out as soon as we cross below it. So what I want to look for on top of that is confluence. So you'll notice that prior to that happening, back here, we flipped over the MACD blue. So what that told me was, once we were on top of the MACD, that's another area where I like to enter in at. So I would have already entered in with 25% of my account once that flipped over blue. So if this is blue and you bought right here, you were in it for that move up right there. And then when it flipped back over red right here, you could have got out. When it flipped back over red right here, you could have got out. But overall, there was no reason to take any move to the upside or downside after this buy right here. You should have been long in this asset because we're on top of the 200. So whatever you're using now for your entry signal, you should have a corresponding exit signal as well. And that should be part of your trading plan. These things should all specifically go into your trading plan. Once we're on top of the 200 moving average, I enter with 25% of my account until we're back below and we get a confirmed candle close on whatever time frame I'm looking at, in this case the daily, and then I can potentially exit my trade or wait for my stop loss to take me out. But one of those two criteria should be in place. So you should have a buy criteria once we're above the 200 moving average on a confirmed candle close on the whatever time frame you're looking at, in this case the daily, and then you should have one of two exits already planned out ahead of time. Either a target to the upside, once we reach 15,000, 20,000, whatever it is, I'm going to exit my position or at least take profits on a quarter of my position or whatever. Or you should have a stop loss criteria in place. Once we cross back below the 200 and close, I'm going to exit my position. So those should already be in place. You should have a criteria to enter, a criteria to the exit, and a target in mind. Those should all be part of your trading plan. So now that's the moving average one. You should have the same thing in place for the MACD. Once this crosses over to the blue, I want to be in this until it turns red again. And then once it turns red, I will exit my position. When it flips back over blue, I will re-enter my position. When it flips back over red, I will exit my position. Or you can say, I'm going to have a stop loss in place, and once it flips over red and we move back to the downside at least 5%, I'm going to exit my position. So that you don't get just chopped out in little moves like this and then miss out on the remainder. Or have to enter, back here, and then you exit here, and then you enter here, and then you exit here, and then you enter here, and then you exit here, and then you enter here, and then you exit here. Because sometimes you're going to miss those if you're not sitting in front of your computer all day, or if you're sleeping, or if you're doing something else, and then you're going to say, oh, it already flipped over blue, and we got this move up right here. I don't know if I want to enter now. I'll wait till we get a pullback, and then it doesn't pull back, and then you're up here, and you say, damn, I should have entered back here. Why didn't I stick to my plan? Well, if you don't have that plan written down, how are you going to stick to it? Because you're always going to be second-guessing yourself, because that's the whole point of the markets, is to abuse your psychology. It's to mess with your mind. That's why you always see, as soon as you cross above the 200, a massive candle like this, and then people are like, oh, I don't want to enter in now. We just got this massive candle, and then it'll sell back off, and then I'm going to lose out. And then right here, it sells back off, and instead of entering, because we come down to retest the 200, you say, oh, I knew it. I'm glad I didn't enter in. Like, that was smart of me not to do. And then it never goes back below the 200, and you never enter into your position. And then you look back at it right now and say, oh my gosh, I can't believe I didn't just enter after that one candle. Well, look what would happen. You enter after that one candle, and the whole thing consolidates around for months, from April back here until August back here. And then we're at the top of a range, and then you're like, oh man, I would have just gotten chopped up for the last so many months, never entered, and then you miss your opportunity because it burst up again. And then it comes back down and retests it again. And all this is using Fibonacci, so that you can tell percentage retraces after that move and look at another advantage to move to the upside. But again, that should be part of your trading plan. So in your trading plan, you should have like A, moving averages, and then define specifically, like we just did, when you're going to enter, when you're going to exit, and how you're going to use stop losses in accordance. And then in a separate part of your same trading plan, you should have MACD, when we're going to enter, when we're going to exit, when, how I'm going to put my stop losses in place or get bearish on the market or whatever. And then you should have the exact same thing in place for stochastics. When I'm going to enter, when the bears are in control is when, you don't want to be in the market, but you want to be potentially looking for an entrance. That's why it turns green here. You're potentially looking for a buy. When the bulls are in control, it's red. It does not mean it's just going to turn red and then sell off. And the opposite of this, where it turns green and then goes to the upside and then it never turns green again. It just means that you're essentially in that danger zone. It means the yellow light has flashed on, but you don't know, is that yellow light going to stay on for 1 day, 5 days, a year? But you want to pay attention because you're potentially going to be hitting the brake soon. So you want to pay attention to it. You want to put your foot near the brake pedal so that when the time comes, you can hit it fast and you don't have to take a big dump to the face because you weren't paying attention to it. But again, the idea is you want to stay in it. As long as this area is red right here, the bulls are in control. That's a good thing. And vice versa right here. When the bears are in control, that's a bad thing. You don't want to be in these markets. The bears were in control right here, very clearly, once it flipped over green. And then look, massive dump to the downside. How did you see it coming? Well, the bears were in control. You can see very clearly the bears were in control of the market. The bulls were trying to fight it and could not. And then we get it down, sells back off right here. And then look, right here, before we cross back over the 200 moving averages, who's in control now? The bulls are in control right here. The bulls are in control right here. The bulls are in control right here. The bears take back control for only a moment, and we get a small sell back off. And then what happens? The bulls are back in control right here. So if you just trade once the bears are in control or once the bulls are in control, that's a specific thing that you can put in your trading plan. I am never going to take a long when the bears are in control. I am never going to take a short when the bulls are in control. So that means once you exit the bullish control zone right here and sell back off, you can potentially look for shorts because you're no longer in the bullish control zone. They have lost control now. But as long as the bulls are in control, you shouldn't be looking for shorts unless you're going to call the absolute top. And how many times are you going to get the absolute top right? Did you get it right here? No. Did you get it right here? No. Did you get it right here? No. Did you get it right here? Maybe. Do we even know for sure yet? Nope. So why try to take the hard trade? Why try to cause more trouble for yourself? So that's the 3 basic indicators. And then all the different parts inside of those indicators are just overcomplicating something. If this chart was just black and white and there was no colors and you looked at it for 10 seconds based on just these 3 things, or 1 minute, it doesn't have to be 10 seconds. You only need one thing in place, a 200 moving average. You don't need all these dots. You don't need all these lines. You don't even need to be able to see price action. You don't need to be able to see any of this. You could literally just look at where the price is at right now and the moving average and tell on or off like a light switch. Is this a bull market or a bear market? Are we above the 200? Bull market. Are we below the 200? Bear market. Same thing with this. Do not need to see price action whatsoever. Is the histogram above the slope line? Yes. Bull market. Is the histogram below the slope line? No. Or I'm sorry, yes. Bear market. This right here is just the time it takes for it to roll over. And then once it flips, it turns red, and then it's confirmed. This is just the time it takes after it moved above it to flip over. So you don't have to call. This is not going to let you call tops and bottoms. That's what this is for. The histogram, when it peaks out like this and then flips over green, that's telling you that's the bottom. When it peaks out like this and turns red, that's telling you that's the top. So there's a huge difference between here, it's telling you that's the top, and then here, it's telling you we're in a trending move in that direction. So if you look right here, it said this was the top right here. It was wrong slightly. Not by time, but by price. Okay? But if you waited till it got right here and turned red, that was right before the big trending move happened to the downside. Right before the big sell-off to the downside. Same thing right here. It did not pick the absolute bottom right here based on that flipping over. This was the absolute bottom. So the histogram told you where the absolute bottom was. The slope line did not. The slope line didn't flip over blue until way back here. But what did it do? It mitigated all this time and all this risk. Told you don't need to be in this right now. You don't need to be in this whole area right here. Then it flips over a blue. Okay, now it's good to get in. Now we're in a strong trending move in that direction. So what is going on right now? What's going to happen in the future? What are we paying attention to right now? The histogram is touching the slope line. So one of two things is going to happen right now. The histogram is going to stay on top of the slope line and we're going to continue trending to the upside, or the histogram is going to cross below the slope line and we're going to start trending to the downside. But it's going to take time from when the histogram flips over below the slope line to when the actual slope line flips over red. So then you can wait and say, once it flips over red, I'm going to enter a short position. And then you can get a hold of this piece right here. And then as long as the bears are in the bearish control zone down here, you're definitely not looking for a long because the bears are in control. Once it exits the bearish control zone, once we start getting multiple green histograms to the upside, you potentially take a long and try to pick the bottom. Or you can just wait for the trend to flip over. And then you can take the trending move to the upside. And the same way you can do that with the moving averages. If we move down to the 200 moving average, that's a buy. That's the best buy you can ever get in a market. Because if the market continues to trend in that direction, you want to be buying it. Where's the best place to buy it? At the flip point. At the pivot. And that's what that is. The moving average is the pivot. The slope line right here is the pivot. That's what these are. This is essentially the parabolic star and the binary pivots. So the parabolic star is the red and the green right here. And what that's telling you is, okay, it's taking into account the ultimate high, which is the top of this candle right here, and it's saying the ultimate low, which is the bottom of this candle right here. So it's telling you once you take out the low of that candle right here, we are now in a downtrend. We have a pivot in the market where support and resistance has flipped, and now we're potentially moving to the downside. So in the same way, we looked at all those other things. When this flipped over green right here, we pivoted. We took out the previous high based on the parabolic star, so then we were in an uptrend. So that was this whole entire time we're in an uptrend. It never flipped back over red. And now we're at the top here and it flipped over red. So what's going to happen? One of two things. We're going to consolidate here for a little while, find support, and then take it back out, and then we're going to enter another trending move to the upside. Or we're going to continue now and take out, we've already taken out the green SAR, so we're in a downtrend now, or consolidation period, and then we're going to fail to put in a higher high, and then we're going to sell back off and test our next resistance. Or, I'm sorry, support. So that's what we're paying attention to. Well, how do you figure out where the support's going to be? You look at the moving average. How do you figure out where the resistance is going to be? You look at the previous high. So that's what you're just complicating an overall simple task so that you can add important steps in to your trading plan. But the absolute basic for the trading plan, the outline for your entire argument, the outline for your entire book that we're writing here is literally going to be the moving average. It's going to be the MACD. It's going to be the stochastic. And then inside of that, there's going to be smaller chapters. And in those chapters, we're going to talk about things like Parabolic Star. We're going to talk about binary pivots. We're going to talk about support. We're going to talk about resistance. We're going to talk about fundamentals. And all those little things are just minute details inside of the big picture. But the big picture is the trending market. And that's the most important thing. And then inside of all that, we can overcomplicate it even more, and we can start looking at things like where the best place to take a trade is, why it's good to take a trade off of a moving average, why we want to buy off the 200. And the reason is because of things like risk reward. If you're at the 200 and you buy right here when it comes down to it, and we buy 12,000, and then it moves to the upside, the amount that it has to move to the downside below that 200 and start closing is tiny. It's from here to here. It's from here to here. It's from here to here. That's telling us our risk. How far below this does it have to close? How far below this does it have to move? At what point in time, once we're below that 200 moving average, are we going to say, we were wrong, we're not going to find support, and the market is going to flip over, and we're going to be in a bearish trend? How far below? That's up to you. That's your risk. Do I have to wait 3%, 5%, 10%? Am I going to risk my whole entire account? Whatever it is, that's fine. Whatever you choose, that's your risk. What is the reward now? The reward is indefinite because it can continue to the upside for, up to $1 million. So if you have to risk 1%, 5%, 10%, 50%, but the reward to the upside is going to be 20%, 50%, 100%, 1,000%, 10,000%. There's an exponential benefit to being long in the market because the reward is exponentially more than the risk. So that's why people like things like Bitcoin is, because maybe Bitcoin goes to 20,000 and sells back off down to 10. So if you bought at 20,000, what did you lose? 50% of your account. That sucks. People don't want to lose 50% of their account. But if you bought at 20,000 and it goes to 200,000, what did you gain? 10x. You gained $180,000 and you potentially lost $10,000. So is that a good trade or a bad trade? That's an amazing trade. You potentially gaining $180,000 to the upside on a $20,000 buy. You're potentially losing $10,000 on a $20,000 buy. So you're risking 50% of your account to gain, essentially a 10x. That's 1,000 to 50 basically, which is like 20 to 1. I think, no, maybe not 21. I think, 20 to 1. Because it could 10x or you could lose 50%. So that's the most simple way to look at things like risk reward. And then why it's so important to look at pivots. Because the pivot is telling you when the absolute best or worst place to enter a trade is. And then you'll notice a lot of times what happens is we have right here our binary pivot lining up perfectly with our 50 moving averages. Why is that lined up perfectly with our 50 moving averages? And why is that important? Because if the 8 fails, which it did, and we find support on the 21 and then move back up, that was our pivot. But based on this confluence right here, this previous pivot, the binary pivot in the market, that's our confluence level. So if we sell back off to that and it lines up with our 50, what does that look like? It's going to look bearish because we're going to potentially be crossing these to the downside. But that's your buy. That's where you want to be taking a buy at because that's your pivot point in the market. So how far does it have to sell down before you know you want to get out of this trade? I don't know, 5%, 10%, 50%. That's up to you. But again, that's telling you if we're at this pivot point right here and then we sell off, what's our next point that we're looking for? The 89. What's our next point that we're looking for? The 200, the 377, the 528. But to the upside, we have unlimited possibility because we could find support and then move back up. So those are the best trades to take is at the pivot points, at the Parabolic Star flips. Because what that is it's essentially the potential of what we call an SR flip. It's support potentially becoming resistance. If we sell down below the 21 right here and then we can't get back above it, that's our support level, which is the 21, becoming a resistance level. That's SR flip. We sold down below the 8. We came back up and it was resistance. Now we're potentially trying to get back above the 8 right now. If this starts to sell off all of a sudden and we sell back below the 8, that's an SR flip. That's a support becoming resistance. And then what happens? We're going to look at the next level, the 8 or the 21. And then if that one does the same thing, we sell back below it, come back up, support becomes resistance, we're going to look to our next level. And that's just our different stairs that we're walking down in the market. And then eventually you get back down to the ground level and then you take your buy off of those different levels. But instead of just taking this whole entire dump to the downside and then buying it to 200 right here, we're getting out of the market based on these different support levels and then re-entering at a lower price. So if the price drops 10% and you risk 2% and get stopped out, you mitigated 8% of your loss. If the price just goes down and you don't exit, you don't enter, all that happened was there was a whole big price action that took place and you gained or lost nothing as long as you just stayed in that asset, which is fine too. That's what you do with like your 401k. You don't just call up your broker and say, hey, get me out of the market, it's dumping. No, you just sit there and you take the loss because it's a long-term investment. And that's the difference between investing in something that's in an overall uptrend and trading something that's in an overall uptrend, is how often you're going to be moving in and out of those markets. But overall, the most important thing is look at the light switch. Is it on or is it off? Am I risk on? Am I risk off? Whatever your determination is, whatever moving average it is, which it should be the 200 in my opinion, on a longer time frame, daily, weekly, monthly, whatever, that should tell you, should I be risk on in this asset or risk off in this asset? And then all the other stuff that we're doing on top of this is just complicating the most basic theory there is. So it's just a matter of, when you're going to leave the house for a minute and the light switch is turned on and you say, okay, am I going to open the door, step outside and pick up the package off my front porch and then come back in? Yes. So am I going to shut off the light while I leave? No, I'm going to leave the light on because I'm going to be right back. And what's going to happen as soon as I come right back in off my porch? I have to turn the light back on. So why would I shut it off? But now, if you're, say, going to go to the grocery store and you're going to be gone for an hour, you might say, okay, I'm going to the grocery store for an hour. I'm going to flip the switch off. I'm going to turn off the lights. And then I'll turn it back on when I get home. That's what the 200 moving average is. It's that determining factor in your mind, your psychological whatever your decision is. Do I need to shut off the lights before I leave the house? Or do I want to just leave them on because I'll be right back? That's what you're looking at it as, on off. And then everything else inside is, okay, am I going to be on the front porch for a minute so I don't need to shut it off? Am I going to be going to the grocery store? Am I going to work for the next 8 hours? Do I want to leave the TV on because, my dog likes the company while I'm gone and doesn't get lonely? Whatever those other things are, that's all the other stuff that we're doing to overcomplicate it. But the number one most important thing is on or off. That's it. Basically, the question is when you take profits on a level or an area because something is telling you to, like in this case, we had triple divergence on the 4 hour, which was in that video I did. So when we pointed out this triple divergence right here, this bearish divergence, the way we determined that was we had a high right here, we had a higher high right here, and then we had a third higher high right here. And then here on the oscillators, indicators, we had a high right here, we had a lower high right here, and then we had a lower high right here. So that told us this is bearish divergence. It's taking less energy to get to a higher price, which means that we're barely using any fuel, but the rocket is going higher. So eventually it's not sustainable. It can only last for so long, but typically it will last for 3 drives. That's one of the most reliable sell indicators. Same way bullish divergence is one of the most reliable buy indicators. And then here, same exact thing happened. We had a high here, we had a lower high here, we had another lower high here. 3 lower highs, 3 drives, bearish divergence, expect to sell off. Part of the reason that I designed this TJD TD MACD is, if you look at the regular MACD, if you look at regular stochastics, if you look at regular RSI, oftentimes they will not give you the third drive right here. You will have one drive, you will not set a lower high right here, and then you will set a lower high right here. So you might have 2 drives of divergence. These are designed to work very effectively and very efficiently. When you exit a position like that, you're mitigating risk. You're selling up here to mitigate risk, which is what I did. I sold spot at 18,000 because it felt like the top. And I said, look, I've made plenty of profits on this position. There's no reason for me to wait for the absolute top. I mitigated risk. I took profits on my position. That's never a bad thing. And that's a micro inside of the macro. That's a small decision that you make, a trade that you make inside of the overall determination that we're in a bull market. Because I'm not going to wait until we come back down to 12,000 and then say, okay, now I'm going to exit the position. And that's fine. That's always good to take profits along the way. You're mitigating risk. You're saying, I'm no matter how bullish I am on this asset to go to 200,000, I'm going to lock in some of those gains right now, and then I'm going to use it to pay my car payment or my house payment or buy food or whatever you want to do with it. Take your principal back out of the market and just play with your profits. That's all perfectly fine. But part of that same thing, again, is once you take this sell, when are you going to re-enter with that position? Never? You're just going to let it run away from you indefinitely? Are you going to re-enter off the 200 moving average down here when we touch it? Are you going to re-enter after we drop 10% and just say, no matter what happens now, it's like I never sold, but I just have 10% more of that asset? Because if you sold at 20,000, let's say, and then it drops down to 18,000, and you rebuy the exact amount that you sold in dollars, you went from 20 down to 18, so you made a 10% profit. If you just rebuy with the $2,000, let's say, that you just made, you can get a 10% profit. But you have two choices. You can take that 10% profit in cash and just stay out of the market, or you can take that 10% profit in the asset and just own 10% more of that asset. So if you owned one Bitcoin before, you can either own one Bitcoin and another 10%, so you have 1.1 now, or you can say, I had $20,000 before, I sold my Bitcoin for $20,000, rebought the Bitcoin for $18,000, so I have the same amount of Bitcoin, and I have $2,000. So that's your choices. Do you want more of the asset? Do you want more dollars? So if you're overall in a bull trend still, overall above the 200 moving average, theoretically, you should be looking to acquire more of that asset at a better price, aka buying pullbacks. If you are below the 200 moving average, it's the opposite. You should be bearish in the market, so you should be trying to go into a cash position long term. Overall, that's your determining factor. What you need to determine, though, inside of it is, again, inside your trading plan, you say all those things, write them down, specific things like, once I sell Divergence at a key resistance, the previous all-time high, over here, when am I going to repurchase? Am I going to repurchase based on a percentage move? 10% down, 20% down, 15% down? Am I going to rebuy the 200 moving average? Am I going to not rebuy ever and I'm just good on that asset? That's all something that you have to determine for yourself. But the most important thing is, once you take profits up here, you're mitigating risk. But the same way you should have a stop loss in place when you sell something, or when you buy something rather, you should essentially have a stop loss in place when you sell something. So you're saying that if we move up here to 20,000 and then we continue, I'm willing to risk having 5% less Bitcoin and rebuying at a higher price. In the same way that if we sell back off down here, you're going to risk 5% of your profits, but if it goes below that, you're going to get stopped out of your position and then you'll rebuy lower. So that's essentially what you're looking at is what's your risk? What's your risk reward? When do you want to get back into that market before you say I was wrong? And that's all a stop loss is. When you take a short position and you say, all right, I'm willing to risk 5% of my account to say that we're going to go down. The same way when you take a buy and you put a stop loss in place, you say, I will risk 5% of my account saying that we're going to go up. But if it goes 5% against me, I will get out of that short position or that long position and I'll just rebuy lower. But the light switch is still either on or off. You need to still be looking at it as an on or off situation. Do I want to be long in this asset or do I want to be short in this asset? What am I willing to risk that I'm right or wrong? And it's easy to think about it like a coin flip. It's really only two things that could happen when you take time out of the equation. You flip the coin, you get heads. You flip the coin, you get tails. Flip the coin, price goes up. You flip the coin, price goes down. Or it can go sideways. So as long as you don't have a stop loss in place, eventually the price will either go up or down. The point of your stop loss is to say, if it goes up by a certain percentage, I will get out of the market. If it goes down by a certain percentage, I will get out of the market because I was wrong. So again, it's the same thing. You're flipping that switch. If you just buy an asset and you just hold it, There's no switch. You're never getting in the market. You're never getting out of the market. You just bought it and now you own it and you're just staying in it. So what you need to determine is how much are you willing to risk? And that's what your stop loss is. And how do you determine if that's a good choice or not? The same way we were talking about before, if you think that Bitcoin could go back to $10,000, you're risking 50%. But if you think it could go up to $200,000, your reward is 10x or 1,000%. So essentially, you're comparing those two things to each other. If you're going to risk 50% with the potential to win 1,000%, your risk is 20 to 1. That's phenomenal. Normally, what I like to look for is a minimum of 2 to 1 risk-reward ratio. I will risk 10% of my account to make 20% of my account. I will risk 10% of my account to make 30% on my account. But I will not risk 10% of my account to make 10% of my account. So if we're right in between two key areas, so like the all-time high and the moving average, look where we're at right now. We're at 18,000. All-time high is 20,000. So that's a $2,000 move to the upside. It's like 10% basically. If we're at 18,000 and we sell down 1,800 from 18,000 would be 16.2. Well, what's at 16.2? The moving average. So we're literally in the exact middle of this range basically right now. So the risk reward to the all-time high is 10%. Your reward is 10% if it goes back to the all-time high and then tops out. Your risk is 10% back down to the 200 moving average. So your risk reward is 1 to 1 right now. That's a shitty trade. You don't want that. That's a coin flip. If you want to just go to the casino and bet red or black, that's perfectly fine. But that's not what this is about. This is about making intellectual decisions based on risk reward, indicator oscillators, all these different things. Otherwise, that's fine. You can just buy something and say it's a 50-50 shot. It either goes up or it goes down based on nothing. It's a coin flip. But what we're trying to do is increase our probability of success. And we do that by having low risk, high reward, and using technicals and even fundamentals to make those decisions. You know, you can be fundamentally bullish on Bitcoin because you believe in the technology for the future. But how do you quantify that into a trading plan? It's very, very difficult to use fundamentals to quantify something. It's very easy to use technicals to quantify something. And there's the best thing that you could possibly do is risk mitigation. So selling at an all-time high is great, and then rebuying higher once you break through that all-time high is perfectly fine. Because you might have quote-unquote lost out on profits, but you mitigated risk. You were at a high-risk area, and you chose not to take that risk to exit your position, and then you can re-enter at a higher level. So it's essentially just like having a stop loss. You said, okay, if I risk 5%, we go higher. After we go 5% above the all-time high, I'm just going to rebuy because I'm bullish again. That's like, I was wrong. I was wrong that we topped out. We're going to keep going up. The same way that if you sell at 20,000 and then the price goes down and then you rebuy off the moving average down here at 16.2, and then you say, if we go down to, 15,000, I'm going to exit my position. 10% stop loss roughly. And that's fine. I was wrong. We're going to keep going down. But if not, I'm going to keep going up, and I got a better position to re-enter off of. And that's what we're using the moving averages for. It's just key areas. The same way we use Fibonacci. If it pulls back, 50% or 61.8 or whatever Fibonacci level you're using, 23%, you're going to rebuy at that level because there's a probability that it sold off 23% of the move, and now it's going to find support and continue moving to the upside. And same way, 50% or whatever, it could be the 886. It could be an 88.6% move back down off of the 100% move to the upside. And then now you got back an extra 88% of the move in your asset. And then you rebought, and then you're still bullish because we're still above the 200 moving average. That's all. That is perfectly fine. But again, it's just overcomplicating something that's super simple. So when you sell up here at 20,000, you should already have, if you're still going to be bullish on this asset, you should already have an entry level back in mind. So when I sold at 18,000, and then I say, if we get a pullback below 18,000, back down to 16.5, I'm going to rebuy what I sold, or a portion of what I sold. So when we sell back off down here and we find support at 16,540 or whatever, and we put in this low and it starts looking bullish again, we get this move back up, get rejected by the 89 and the 8, and then we sell down again and we put in a double bottom, that tells me, okay, now I'm going to re-enter this position. We found support at this previous support level. We found support at the double bottom right here. And if you look at your indicator oscillators, we potentially put in bullish divergence. So that's what I'm looking for to re-enter a position. And then once again, I'm going to look up here to take profits again. But if you're looking at moving averages, the 8 and the 21 cross back to the upside. So on the 4 hour, you should be bullish again. We're still above the 200. So on the 4 hour, you should be bullish again. But now what I'm paying attention to is, are we potentially going to be topping out this trend? And then what you start looking for is divergence again. So look right here. Look where the stochastic's at. We're way back up at 93. Look where our previous top on the stochastics was at. 80. So what is that? It took a shitload of energy to move the price up substantially less. That's hidden bearish divergence. The oscillator had a bunch of energy. The price is not nearly as high. So it means right now the bulls are trying their ass off to get this price back up to the top. Why are they trying so hard to get back up to the top? Why is someone buying a ton of crypto right now, trying to move it back up to all-time highs and spending way too much energy doing it? Divergence. That's bearish divergence. Divergence between the oscillator and the indicator. That means there's a shitload of buying going on right here, but the price is barely moving. Usually the reason that's happening is because somebody had a position up here and just ate this entire dump and doesn't want to just hold this because they think we're going to continue through the downside. That's what that bearish divergence is telling you. So usually what happens is they'll push the price back up to that key level, to that previous support level, which is like right here at 18,000. That was our support. And then they're going to get back up to 18,000 and then they're going to dump their position. And they're going to get that exit because they don't want to take this loss right here. Maybe they bought at 18,000. Maybe they bought at 16,000. Maybe they bought at 4,000. But regardless, they have enough money and enough control in this market to move the price back up and then sell it off back there without taking this loss. So that's what that divergence is telling you. Someone is trying extremely hard, based on stochastics, to move the price back up here, and it's failing to get back higher. If it was convergence, if it was normal, what would be happening is this would be extremely high, price would also be extremely high. Or this would be extremely low, price would also be extremely low. So this indicator should not be nearly as high right now if there was convergence in the market between price action and the indicator. And then if you look at MACD, we are getting convergence right now. The MACD peak right now, as of now, if it just started rolling back over, is lower than the previous high. And the price action right here is lower than the previous high. So that's convergence. So the two indicators, oscillators, are disagreeing with each other. The stochastic is saying there's massive divergence in the market. We're getting ready to sell off. The MACD is telling you everything lines up, looks good to me. So that's a less reliable trade because one of those two things is going to be wrong. But when you have a situation like this where we have 3 different points, and between those 3 different points, both our indicators are lining up perfectly and telling us the same thing, that's extremely reliable. And that's why we use both these, because they don't always tell you the same thing. And people that use indicators that always tell you the same thing, that's great. It's like having 3 friends that always tell you like you're a charming, handsome guy and chicks love you. It's awesome. It's good for your self-esteem. Everybody likes compliments. Or maybe your wife always tells you how much she loves you and how you're the best husband or whatever. But do you want to just be told something, or do you want it to actually be true? So that's why you look at all these different things and tell you, is this thing lying to me right now to make me feel good? Or is it telling me actual useful information? So that's why when we use all these different things, we don't look for ones that always line up. We look for ones that tell us different things all the time. So we can determine when they're all agreeing, man, maybe I am just really charming and handsome and look good today. And that's what's so important, to have these things that are not always agreeing with each other. You don't want a bunch of yes men around you. You don't want your friends to always tell you like how cool you are and how awesome you are and how chicks love you or whatever your situation is. You want the truth. Everybody's got that one friend that just tells them the truth, no matter what. You know what I mean? Like, bro, You got black shoes and a brown belt, man. You look like an idiot right now. Or, no, that shirt's stupid. Whatever it is, you don't always just want a bunch of yes men around you. And that's what these indicator oscillators are for. People that always use the same ones because they say, yes, they're all agreeing. And then they're like, I don't know what happened. All of them are telling me the same thing and I was wrong. Well, because you're probably using a bad combination of things. So, and volume will often tell you the same thing. You see this big volume spike right here. When you see a big volume spike like that, it's usually telling you that's a high or a low. So when we saw this massive volume spike right here, we say, okay, there's a big volume spike. It's probably the bottom. So let's look at our indicator oscillators and see if they agree. In the same way that you can use, a volume weighted indicator down here. That's what the waddah attar explosion is. This takes into account price action and volume, puts them together, and then it tells you accordingly. So when you see volume spikes, you might see a volume spike on a breakout like this, it's definitely a high amount of volume, but it doesn't just mean we're going to sell off. But then when you see a volume spike on a sell-off like that, it means this might be a temporary bottom, but it doesn't mean Bitcoin's just going to go to zero. And the same way that you see that with total market cap dominance or total market cap or Bitcoin dominance or whatever other indicator oscillator you're using, you can use those things to tell you important bits of information, but it doesn't just mean like 100%. That's it, it's going to sell off or it's going to keep moving or whatever. It's just one more thing that you can use as a tool to determine what's going to potentially be happening. And then when you start doing this long enough and you follow the same indicators, same oscillators, same price action long enough, you can start say, wait a minute, I recognize this signature from the top in 2017. We had triple divergence, we had this was telling me one thing, that was telling me one thing, and this one was disagreeing with it. And then you look back at that signature, and that's essentially like what a fractal is. It's basically like a previous pattern or previous, indicator, whatever, that's going to tell you something happened before it happened based on experience. And it's the same thing with like moving averages. Once you see a moving average cross between, say, the 50 and the 200 to the upside, they call that the golden cross because typically in experience, once the 50 is above the 200, that you're entering a bull market. And based on previous fractals, based on previous experience, based on, hundreds or thousands of years in markets, whatever you want to look at, telling you like this is very likely going to happen. Same way with the death cross. Once that 50 crosses below the 200, it can either find support and continue to the upside and it was a fake out, or it was unsustainable, or the bears lost control, or it could tell you we're entering a long-term downtrend, mitigate risk, exit your position, and then if it crosses back to the upside, you can re-enter at whatever price accordingly. But you didn't risk all that time or all that money staying in that asset unnecessarily. That's what we're paying attention to right now. We sold off finally. We found support on one of our diagonals, and then we moved back up. Now where are we at right now? We're back at a support level. This was previously a resistance, this green line right here. Then we broke on top of it, and then we moved back down to it and found support. So that's a SR flip. Resistance became support. Resistance came support. 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 All these times we found support. And then we moved up here and we got away from it. We moved away violently to the upside. And then we found resistance on the all-time high. And when we sold back off, what did we do? We came back down and found support again on our previous resistance that we flipped over to support. So as long as we keep finding support right here, there's no reason to think we can't just keep moving to the upside. But if we break down below it and then find resistance, then we're going to look for our next support. And then if we find support on that, we're going to stay on top of that, move back up, keep going to the upside. But if we break down below it, we will expect to come back to it and test support again. So this red line right here, that was a previous resistance, resistance, resistance. We broke above it, support, 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 failed to hold as support, retested as resistance, found support lower, found support higher, and then look, we're retesting that resistance one more time. If we get back above it, it will be exactly like what happened to the green line right here. And then we find support and continue to the upside. If we break through that 20,000, that would be again resistance, 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 break above it, support, support, continue to the upside. So what we're paying attention to right now is an SR flip potentially happening. We lost this support right here and it became resistance. And now we're at it now and it's resistance. So is it going to stay as resistance? We're going to sell back off? Or is it going to act as support and we're going to break above it? So now that's what we're paying attention to. So one thing that's important right now to pay attention to is this. We are currently at 18,113. What happens today? It's Sunday. It's the end of the week. So it's 7 p.m. Eastern Standard Time. The weekly is going to close on spot. Before that happens, futures is going to open. This is the futures chart. Futures closed on Friday at 16,925. So one market was closed when price was 16,925. Meanwhile, we're at 18,100 and say 18,000. So we have roughly $1,200 difference between spot and futures. That's like not quite 10%, 8% or something like that difference. So one of two things is going to happen for sure. I can bet anything on it. Price is either going to skyrocket up on futures by $1,200, probably more because typically futures trades at a premium of, $100 to $500, or price is going to dump on spot. But one of those two things is going to happen. They're going to come back in line. Why is that a fact? Because of arbitrage. What does arbitrage mean? It means that if I own spot Bitcoin and it's worth $18,100, I can buy futures Bitcoin at a lower price and then sell my spot and still own the same amount of Bitcoin. Or I can sell my spot Bitcoin, sell my spot Bitcoin at $18,000 right now and then rebuy futures lower, or I can buy futures lower and then sell my spot at a higher price. But eventually that gap is going to close. Otherwise, somebody would just go on futures, buy a shitload at 16,000, whatever, and then sell a bunch of spot at 18,000. So it doesn't make any sense. The gap has to close. And that's what the gap is. It's when one market's closed and another one's still open. So while Bitcoin spot is trading over the weekend, futures is closed. So when futures reopens, arbitrage is going to bring those two things back into line with each other. If they don't come back and retest at that same point, there will be a gap left. And you could have a runaway gap where price continues to move up or down and does not retest and fill that gap. Or you can have just a temporary gap where, we come back down, we fill it, and then we continue moving in whatever direction, whether it's down or up. But those two things will come back into line. It's very, very rare that you will see futures market and spot market trading away from each other for an extended period of time. It's possible. Very unlikely. So what's going to happen later today based on what we just discussed? Bitcoin spot is going to drop $1,200. Or Bitcoin futures is going to jump $1,200. Which one's more likely to happen? In my opinion, based on previous experience, weekends are technically and statistically bullish. We almost always pump up Friday, Saturday, and then going into Sunday, either Saturday night or Sunday during the day, we almost always sell back off in line with futures. And then after that, we can continue to the upside or we can continue selling. Usually continue to the upside. But statistically, spot is bullish on the weekends. Part of the market participants are not participating in the market. So then it's easier to move the market in whatever direction you want, especially after a sell-off. It's easier to push the price back up to the support level, and then you can sell it off once futures and spot come back into line, and then we can continue to sell back off to the downside. Or we can push up here, find support again at the resistance, and then continue moving to the upside. But it's easier to move the market if only half the people are in the market, or less than half the people, or even if it's 80% of the people are in the market versus 100% of the people in the market. Because 20% of the people are not on the road. Half the drivers are not on the road, so there's no traffic So it's easier to, zip around and move around without a bunch of people all in the way. And that's the way you look at the difference between them. So what we're going to pay attention to now is we're at a key support, or resistance rather, is a perfect spot to take a trade off of, in my opinion. Because what's the risk reward going to be? Well, you could risk 2% off of 18,100 that says, look, if we move up to the upside by like $350, I'm going to assume I was wrong and futures is going to be skyrocketing up $1,200. Or you could say, I'm going to short right here, and like I said, if I'm wrong, $360, 2%, we're going to get a 10% move to the downside. Or I guess not 10%, but $1,200 move to the downside. So you're essentially saying, like, I'll risk 2% to make 3% or 4%. 2-to-1 risk reward. It's not a bad trade. Do I think that we're going to sell off and futures is going to, determine price action? I don't know. You look at likelihood, you look at indicators, you look at oscillators, and then you can make an educated guess. So let's look at stochastics. Look where stochastics at. Oh, that's weird. It's way, way up here. Bulls are in control here. But if we look at futures, that's not the case. And yet, price is substantially lower. So based on this divergence that's taking place, I would say that we have one indicator now telling us we're more likely to sell off from this level. So now we have an advantage on the market because we have a potential risk reward that's higher if we move to the downside versus if we go to the upside. And then we also have a level of divergence, hidden bearish divergence, telling us that we're more likely to sell off. So we have a higher reward to risk ratio that we're going to sell off. We have also an oscillator indicator telling us that there's divergence, saying we're going to sell off. So now we have an edge on the market. We're not just flipping a coin. We're flipping a coin and saying there's a higher likelihood that tails is going to come up than heads. Maybe it's 5% higher. Maybe it's 2% higher. Maybe it's 50% higher. Those are all what we determine whether or not that's a good trade or not. But we're looking for an edge on the market. And that's what we're getting right now. So that's, if you had to go by no bias, nothing else, no previous experience, nothing, you would look at, is there a higher risk reward to the upside or to the downside? And is there any of my oscillator indicator, price action, moving averages, whatever, telling me there's a higher likelihood of one of those two things happening? And then if enough of those things line up, you can take that trade in that direction and say, even if I'm wrong, if I take that trade enough times based on risk reward and, indicator oscillators, whatever, reliability, it's a good trade. Even if it's not good this time or next time or the time after that, if I take it 100 times, I'm going to be right 60 times. I'm going to be wrong 40 times. So as long as my risk reward is higher, or even if it's dead even, as long as you're correct more times than you're not, you're going to make money. So if you can get a high risk reward and you get a high likelihood of success, you're going to make money exponentially fast. If you have a 50-50 shot and you just flip a coin, you're going with luck. If you have a 50-50 shot, but you get $2 if you're right and $1 if you're wrong, you're going off risk reward. If you have a 75% chance of success and 25% chance of failure, your risk reward is higher than your reward is higher than your risk. So if you start factoring these different things in, your profitability, your risk reward, your likelihood of success, your overall determination of the market, that should give you a bias in one direction or the other. If we're above the 200 moving average, there's a higher likelihood that we're going to stay above the 200 moving average in a trending market, so you should be naturally bullish. So you want to be taking trades to the upside. If you start taking into account all those things and you have predetermined set of stipulations and a trading plan in place and what profit levels you want to take profit at based on percentages, based on resistance, based on moving averages, whatever those things are, and you predefine them, then you can go back and look at your trade journal and you can say, I took this trade because we were above the 200 moving average, therefore I was bullish. There was a 2-to-1 risk reward ratio because the next key resistance was at $20,000 and we were at $16,000, but the next support was at $14,000 and we were at $16,000. So it was a 2-to-1 risk reward. If you start writing all those things in a trade journal and you start following the trading plan, you can then look back and say, this is a very high likelihood of success. This is a very low likelihood of success. When I see triple bearish divergence, it plays out 75% of the time. When I see regular divergence, bearish divergence, it plays out 60% of the time. So you say, which one's more reliable? Triple, obviously, much more substantially. So then you can weight your decisions based on your likelihood of success. Once you start actually doing that and putting in the work, and you stop just treating this like, roulette wheel or flipping a coin with your buddies or betting on a football game, you start doing what odds makers do. You're figuring out a likelihood of success that's not clear to everyone. When you ever go to a bar and watch a fight or a football game, and say it's whoever, the Giants versus the Jets, and they're getting ready to play, and the odds are 2-1 in favor of the Jets, and you say, wow, 2-1 odds. Yeah, I'll take that. Well, there's a reason there's 2-1 odds. They're much more likely to win based on somebody that sat there and did the work and did the statistics. And that's what it's all about. It's same with the fight. You got Tyson and Roy Jones Jr. and you say, oh, Tyson's great. Roy Jones Jr. is great. And your buddy says, let's bet $20 on it. Well, are you going to give each other odds, or are you just betting straight up winner? Because that's a coin toss is straight up winner. But odds is, weighting what's going to happen based on its likelihood of success. So whoever the favorite is weighted to be more likely to win based on somebody that did a bunch of work, based on the amount of people that are betting on that person and the amount of dollars that are betting on that person. Or you can take it in the other way. You look at a football game and you say, okay, you can bet either on the straight up winner, and I'll give you a handicap. So you can bet Jets to win, but they have to win by at least 6 points, or I win. So that means if the total score is 20 points versus 25 points, you might have picked the winner, but you didn't win by enough points because of that weight. Those things are the same way that Vegas odds are calculating likelihood of success, or they're calculating how much the success is going to be by. And that's all we're doing in crypto markets is we're doing statistical analysis, technical analysis based on likelihood of success, based on previous experience, and we're just creating odds for it essentially. And that's the way you have to look at it. Because if you just go in and say, I'm going to spin this roulette wheel and there's a 50% chance it's red or a 50% chance it's black. Assuming there's no green. Is there a difference between what the last number was and what the next number is going to be? Statistically, no. Every time you spin that wheel, there's a 50% chance it's red or a 50% chance it's black. But if the wheel just spun 19 times in a row and it was black, is there a higher likelihood that it's going to be black again? Or is there a higher likelihood it's going to be red this time? There's no difference. It's still 50% every spin. But what you're looking for is the trend. If it is just gone black 19 times in a row and all you did was just bet with the trend, if you bet on the third bet, black again, and then you said, well, I'll just bet black again and go with the trend. I'll just bet black again and go with the trend. And then it goes in a row 19 times. You're going to be freaking rich. But if you just keep saying, well, it already went black 12 times, so I'm going to bet red this time. And then it goes black again, and you say, well, it went black 13 times, so I'll just double down on red now because it's got to go red. It doesn't got to go red. It's 50% every time you spin it. And it's the same way with a trend in crypto. If the price is going up, the likelihood is it's going to go up just as likely as that it's just going to all of a sudden start selling off. But if you're in a trending move, it means you're trying to call the top every time you bet against that trend. Or you can just go with the trend, go with the flow. Go talk to a dealer or whatever you want to call him. Yeah, I guess it's still a dealer, whatever. The person behind a roulette table, who spins the ball, who's been doing it for 20 years or 50 years. They'll tell you the same thing every time. Go with the trend. Why do they tell you that? Because the likelihood of the trend continuing, for whatever reason, statistically, is higher than the likelihood of the trend just all of a sudden reversing. Because if it wouldn't be a trend otherwise. And it's the same way with markets. People bet on the trend because the likelihood is that it will keep going in that direction more likely than it's just going to all of a sudden reverse. Because it only ever reverses one time. There's only ever one top. But there's how many candles in a row when that trend started with the moving averages. That's the same thing as the roulette wheel. Once we moved above that 200 back here, this trend has been going for how long? So anytime you ever bet on this trend against it, you were wrong eventually. You might have been right here for a little bit. You might have been right here for a little bit, 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 right here for a little bit. But all you had to do was not sell, and you're in an uptrend. Eventually, took out the price. And you could say that about Bitcoin back when it was at 20,000. You could have bought at Bitcoin for $20,000, held it for the last 3 years, and now you're right back to where you were. So as long as you didn't sell, you didn't lose any money. And it's all about the timing of the trend, the likelihood of the trend continuing. And if you look at this trend right here, this is what, 2011 back here. So as long as you didn't sell, you're winning. As long as you didn't sell, you're winning. As long as you didn't sell, you're winning. So on a long enough time frame, if an asset is bullish, it's going to eventually go back up and continue. And that's where you look at fundamentals and say, I believe in Bitcoin. I'm looking at this chart and it's in an uptrend, so I'm going to keep betting on it. Treating this like, work or responsible way versus just, coming in here and saying, I just want to throw some money around. Because I'm going to tell you right now, if you want to bet, go to a casino. It's fun. They have drinks. They have bright lights. They have girls. If you want to trade or invest, do your homework first. I don't know about other people, but when I want to buy a car, I don't just go to the lot and listen to what the guy says. And if he says this is a good car, I buy it. No, I go online. I look at reviews. I look at gas mileage. I look at the price. I look at the, how long is it going to last for? I look at the predecessor model of that car. I look at, what did people say about the trunk space? Whatever is important to you. Oh, this is a great car, but they put shitty tires on it and I spun out and crashed in the ditch the first time it snowed. Well, that sucks. So I need to either buy that car and put better tires on it or buy a different car. But whatever it is, you do the research. And that's what this is. You need to do the research. And if you're not going to do the research, do what you know works. You go out and buy a Toyota Corolla because it's got, the #1 best rated car of all time. You go out and buy Tesla, and as long as it's above the 200 moving average, you stick with it. And look, this is another example too. This is the weekly S&P. Weekly S&P. Retest of the 200 continues to the upside. This is back in 2016. Retest the 200 twice, moves to the upside. Finally sells off. Retest the 200, moves to the upside. Finally sells off. Retest the 200, dumps all the way down to the 528. New high. So these moving averages on the weekly time frame are absolutely phenomenal. You could have bought this at any point in time back here and never been negative. You could have bought it at any point in time back here and you might have been negative once, twice, but if you held it long enough, it's going to the upside. That's a trend to the upside. Stocks are literally designed to go up. Now look at Tesla. Tesla on the weekly. Sold off below the 200. 200, 200. Sold off below it. You want to be out of the market. Comes back up. Retest. Fails. Comes back down. Higher. Low. Breaks above it. You want to be in it. Retest. And now it's going parabolic. Look at Apple. Retest. Retest. Bullish. Retest. Can't get back down to it. But now, let's look at these on a shorter time frame. This is Apple on the daily right now. We retested back here and got all the way down to the 377 and then the 528. That was back in March when we dumped. And then we put in new all-time high. And now what's going on? We have the red and yellow are fighting to stay across to the upside. So we're potentially losing this trend and finding support on the 89. So the next target, if this moves back down to the downside, look what's happening right now, an SR flip. We cannot get back above the 8 and the 21. They're getting ready to cross to the downside. Next target will be the 89. If that fails, we're going down to the 200, $98. That's what I'm looking for. I'm looking to buy Apple at $98.82 off the 200 moving average. Because long term, we're in an uptrend. And if you buy the moving average enough times and at the right areas and you mitigate risk and you use position sizing accordingly, eventually Apple's going to go up because it's a good company. It has good fundamentals. It has good technicals. They make awesome stuff that people buy. They have assets that are worth money. Let's look at Tesla. Now on a shorter time frame, on the longer time frame, they look the same. They both found support on 200 and moved to the upside. Look at Apple or Tesla right here. Did the exact same thing Apple did. Sold all the way down to the 377.528. Moved to the upside. And now what's happening? Apple was consolidating, potentially getting ready to lose its trend and go down to the 89 or the 200. Tesla is going parabolic and putting in new highs. So on a long time frame, these are both great assets. But on a shorter time frame, Tesla looks way better than Apple does. And that's the same way you could look at like Bitcoin versus Ethereum or versus Ripple or something like that. They could be assets in the same market, both be bullish, but one looks technically better than the other. So you're going to be hard pressed to find something that looks better than Tesla. It's probably going to be some other tech stock, something like that. That's why you can use the same thing on different time frames to get a different view of two different assets and make decisions accordingly. So that's how you determine capital allocation. And when you start mitigating your risk in something, if you have $1 million and you're only investing 10,000 of it, who cares what you're investing in? Because you have 990,000 more dollars you can invest wherever you want. But if you only have $10,000 and you put all 10,000 in Apple and then it starts looking like crap and meanwhile Tesla's running away, you're going to say, damn, maybe I should leave some of this Apple stock and go buy some Tesla. So that's why you do position sizing. You say, I'll put 10% in Apple, I'll put 10% in Tesla, I'll put 10% in Bitcoin, I'll put 10% in gold, and then you mitigate risk between all those different things. You diversify your portfolio. It's only a stupid person looks back and says, I should have just went all in on Tesla. I'd have so much more money. Because it's great when you're right, but it's devastating when you're wrong. Because if you said, I should have went all in on XRP, and you bought it at $2, and then it's been at 50 cents for the last 3 years, 25 cents for the last 3 years, you say, damn, that was stupid. I should have mitigated my risk. Should have diversified. Should have bought Tesla. Should have bought Bitcoin. Whatever it is. So the idea is not about being right all the time or being wrong all the time. The idea is about diversifying your portfolio. So when you're right, it's great. But when you're wrong, it's also great. Because you didn't just get wrecked. That's why gold is so good. Gold can sit around forever, but gold's going to be worth something eventually. Tesla, if you start look at Tesla's market cap. Right now it's great. The price is great. The market cap is extremely high. Look at what their assets are valued at. I think I can't even remember off the top of my head. But the total market cap of Tesla is substantially higher than the assets that Tesla owns. So you have to believe in one of two things. You have to believe that Tesla is either overvalued, or you have to believe that they have assets that are worth money, like for instance Elon Musk's brain, that are not quantifiable by physical assets. And there's different ways you can look at different things. Like Berkshire Hathaway, for instance, has an extremely high market cap, but they also have an extremely high amount of assets. So if something happens with Berkshire Hathaway, they can sell off their assets and pay off their debts and break even. If something happens with Tesla and Elon Musk dies, and they say, well, we'll just sell off all Tesla's assets, it's going to pay 1/50th of Tesla's debt. Or, well, I shouldn't say debt, but market value. So that means that theoretically the stock is going to crash horribly. So one of two things: the stock is either extremely overvalued or the assets are extremely undervalued. So that's when you start looking at a company and they go to sell it and somebody says, okay, well, your company has $1 million in assets and the market cap on your company is $10 million. What's the other $9 million? Well, Elon Musk's brain is worth $9 million because he's invented a bunch of cool shit. And you say, okay, yeah, that makes sense. But if somebody goes to sell a clothing company and they say, I want $1 million for it, and you say, okay, well, looking at your assets, you have $10,000 worth of assets. Why is your company worth $1 million? If you don't have a good idea that's worth the difference, you go on Shark Tank, they're going to laugh at you and tell you you're stupid. And if you don't watch the show Shark Tank, I highly recommend it. It's a great way to learn about business and the way that you learn decisions like what a company is actually worth based on revenue, based on profits, based on assets, based on, fundamentals. I'm sorry, technicals rather. You can't do that with things like crypto in the same way because you can't quantify how much the Bitcoin network is worth. There's billions and billions of dollars in the Bitcoin network and 10 years of work that's been put into it. So it's extremely hard to quantify the level of security and the value of the network. So nobody really knows what it's actually worth. So people speculate on price. But if you look at an actual company in real world that has assets, profits, revenue, you can look at it and say, okay, it's worth this much because of this. It's harder to do that with crypto, which is why it's so volatile. Because all of a sudden when it starts dumping, people start getting scared and say, oh God, it's crashing, it's got hacked, an exchange closed, one coin is dumping assets, Satoshi's coins moved. That's why fundamentals are like so crazy in crypto and price volatility is so crazy in crypto. It doesn't do that in gold. Why doesn't it do it? Well, gold is worth $1,800 an ounce. How much money does it cost to take an ounce of gold out of the ground? I can't think off the top of my head, but I want to say it's like $500 or $600, something like that. So what's the lowest it's going to go down to? Probably the price it costs to take it out of the ground. And realistically, who's going to sell you gold at that price? Probably no one. So there's a different level of intrinsic value based on the amount of work that goes into something or based on the belief system in it. But let's say tomorrow, all of a sudden, somebody comes up with a crazy formula and says, oh my God, I figured out how to make gold out of lead. And they can take a magic potion and dump it on a brick of lead, and then all of a sudden the lead turns to gold. What's going to happen? Gold price is going to dump. Why is it going to dump? Because of fundamentals. Because now there's potentially an unlimited supply of gold for super cheap. Does that mean that all of a sudden there's a bunch more gold? Nope. There's no more gold. Somebody just figured out how to do that, but hasn't actually done it yet. That's the difference is. And it's the same thing with crypto. All of a sudden crypto dumps and people say, oh my God, Satoshi's coins moved. Well, did he sell any of them? No, but they moved, so now people are scared. So that's like the type of shit you got to keep in mind when you're trading different assets is. Intrinsic value, the ratio of what they're actually worth to what they cost to, what they have in assets. Like all that stuff is super relevant. And that's why all these different markets are super relevant. And that's why the more knowledge you have, the more power you have. Because it's going to tell you like how important fundamentals are compared to technicals. How important, intrinsic assets are. How important like factories are. Stock, inventory. Like all those things are different and they're evaluated in a different way. And that's why the stock market right now is extremely dangerous. Because historically speaking, we look at the value of something based on price and earnings. Well, if you look at all these companies, price to earnings ratios a year ago, they might be 20. It costs 20 times what they earn in a year. So if you buy that stock, theoretically, it's going to be worth more money in the future because what it costs now compared to what they make in a year. If you hold it long enough, they will have paid off all their debts or whatever, and then the stock price will eventually go up. Well, right now we have companies that are like 50 and 60 times price to earnings. What does that mean? They're either really expensive because the price went up and the earnings stayed the same, or they're really expensive because the price stayed the same and the earnings are way down. And that's most companies right now. You look at airplanes, you look at cruise lines, a lot of the prices on some of these things are the same as they were a year ago when things were normal, but they're making no money. They're making net money, negative money, net negative. So that's why the markets are extremely dangerous right now. And so you could make more money to the upside, but you could also mitigate risk by just playing it safe. Because if you start losing your principal, you don't have anything left to invest with. So if you have $100,000 and then you lose $50,000 of it, and then the markets crash and you lose your job, you don't have another $50,000 to put in. But if you have $100,000 and you pull out $80,000 of it and you don't lose your job, you might have an extra $50,000 every year to invest. So it's all about mitigating risk just in case something goes wrong. And that's what all these markets are important for, and that's what diversification is important for. But you don't want to do what they call diversification, which is where you just buy a little bit of everything. You buy some Ripple, you buy some Neo, you buy some Bitcoin, you buy some Etherium, because some of those are going to be bad investments. So it's important to diversify, but it's important not to just buy a bag full of crap, which is what the S&P is right now. The S&P is a bag full of crap. Because if you break down all the individual stocks inside of these index funds right now, the majority of them are doing shit. They're doing horrible. But there's a couple big ones that are overweight that are carrying the whole market. And it's like that for everything, not just the US. But, there's a lot of different fundamentals and technicals and things that need to be taken into account that people don't talk about. And most of the time people don't talk about them because they don't know about them. So, but anyway, any questions based on the rest of that, or I think we're going to wrap it up for today. Going once, going twice. All right, cool. Everybody good? All right, excellent. I'm going to go ahead and wrap it up there, guys. Appreciate everybody that showed up today. Appreciate everybody, all the support. If you have any other questions later on, let me know. If you watch this video later on and have any other questions, feel free to ask. Highly recommend that people put in the work. Highly recommend that you guys start to write out an actual trading plan. I'm not hating on anybody. I'm not busting anybody's chops. I know most people have full-time jobs, kids, families, pandemic, sickness. There's a ton of crap going on right now. I totally get it. But you can watch TV and have a notepad, and while you're doing it, write down a couple reliable things or a couple notes or whatever. Same way you don't just write a book overnight and then get it published. Take notes, write out an outline, fill out the paragraphs, edit it, reread it, edit it again, reread it, have somebody else read it, and then finally you publish it. And that's what you should be doing with your trading plan. And that's where your trading journal comes in. Your trading journal is just notes on success and notes on failures that you can look back at later and say, oh, maybe I should take this out because it doesn't work. Maybe I should overweight this because it works more often than not. And then eventually, after months, years, decades, you're going to have this flawless, amazing trading plan. And no matter how much you like people or work with people or whatever, you're not going to share it with them because they need to learn for themselves and put in their own work. So you give people tips, you give people advice, you help people learn, but they have to do the work themselves. And I might teach you guys a couple things, and then one of you might have a better trading plan than me that's more successful, but you take less trades. Or somebody else might have a trading plan that has a less likelihood of success, but they trade a bunch more. So I might enter a trade once a week. You might enter a trade 5 times a week. You might end up making more money than me, but I might end up putting in less work than you. So that's where it all comes in. Like if you work a full-time job, you can't look at the charts all day, every day. If you don't work a full-time job, you can take a bunch of extra trades and get in and out of them and make more money. But it's about finding that balance. Because the best thing you could possibly do is enter a minimum amount of trades and make a maximum amount of profits. And then in between there is diminishing returns. So again, what worked for me or for somebody else might not work for you. But the most important thing is figure out what works and then fine tune it over time. And you'll have the highest level of success in these markets and any other market. And one day you will look back and say, holy shit, all I had to do was put in the work and now it pays off dividends for the rest of my life. The same way if you buy a good stock, it pays you dividends over a 30-year period and it pays for itself and so much more. And then one day you're sitting back doing nothing, making money. That's the same way all this works. So there we have it, guys. Appreciate everybody coming by. I'm getting out of here. If you have any questions or whatever, post them up.